The global oil market is on edge. OPEC Plus is considering a shock production increase of up to 548,000 barrels per day, triple what analysts expected just weeks ago. This sudden shift comes as escalating military tensions involving Iran threaten one of the most critical energy corridors on the planet. The decision now facing OPEC Plus could determine whether oil prices stabilize or surge sharply in the coming weeks. Reports indicate the alliance may raise April output significantly, a response to U.S. and Israeli strikes targeting Iran, retaliatory actions, and explosions near Iran's key export hub. The stakes are high. Iran produces over 3 million barrels per day and exports most of it. Critically, 20% of the world's oil supply passes through the Strait of Hormuz. Any disruption there would send shockwaves across global markets. To understand the gravity, consider the context. Global oil demand is near 105 million barrels per day, and OPEC Plus controls roughly 40% of production. Brent crude has already climbed on geopolitical risk. Historically, a 10% rise in oil prices adds 0.4% to global inflation. When oil surged in 2022, inflation hit 8–10% in major economies, forcing rate hikes. While inflation has cooled, it remains fragile. Earlier this year, OPEC Plus paused production increases. Now the strategy has pivoted from lifting prices to preventing panic. Saudi, UAE, and Iraqi exports are trending upward as a preemptive stabilization. However, if the Strait of Hormuz were disrupted, a massive supply of 15 to 20 million barrels per day could be affected. The proposed increase would calm markets, but won't offset a major shock. Several scenarios are emerging. Limited escalation could see oil stabilize between $85 and $95. A temporary disruption to the strait could push prices above 110. A worst-case regional shutdown, taking Iran's 3.3 million barrels per day offline, could slow global GDP growth by 1%. Energy shocks ripple through transportation, food, aviation, and manufacturing as oil remains the backbone of global commerce. The bottom line is clear. OPEC Plus is not acting because markets are strong. It is acting because markets are nervous. This is crisis containment, not expansion. If tensions cool, volatility may fade. If tensions escalate, the world could face higher inflation, renewed interest rate pressure, and slower growth. 20% of global oil flows through one narrow strait. That is the vulnerability. Geopolitics still drives economics, energy still drives inflation, and the world is watching what OPEC Plus does next.